The financial world is a complex ecosystem. Within this intricate web lies derivatives. They play a crucial role in global markets. Derivatives are contracts. Their value hinges on an underlying asset. To understand derivatives today, we must trace their origins. Derivatives have a rich history dating back to ancient Mesopotamia. Early farmers used them to hedge against crop failures, securing their livelihood. Fast forward to the 17th century, the Dutch tulip mania saw the first recorded use of options contracts. In modern times, derivatives have evolved significantly. The 1970s marked a pivotal moment with the establishment of the Chicago Board Options Exchange. This era introduced standardized derivatives contracts, revolutionizing the financial markets. Today, derivatives are a cornerstone of financial strategy used by corporations, investors, and governments. They offer tools for managing risk, speculating on market movements, and optimizing portfolios. Yet they remain complex instruments that require careful understanding and management. Remember, this video is for educational and entertainment purposes only. It's not financial advice. This exploration dives into swaps, futures, and options. Each serves distinct purposes. Swaps involve cash flow exchanges. Futures are set price contracts. Options give buying or selling rights. Derivatives are financial contracts. They differ from traditional assets. Their value is derived from an underlying asset. Imagine a derivative as a side bet. You're wagering on its performance. Derivatives are versatile financial instruments linked to various underlying assets. A farmer might use futures to lock in corn prices. Corporations use currency swaps to manage exchange rate risks. The value of derivatives is tied to their underlying assets. As the asset price changes, so does the derivative's value. Derivatives are used for hedging and speculation. Hedgers offset potential losses. Speculators aim to profit from price movements. Leverage can amplify returns and losses. Understanding risks is crucial in derivatives trading. Derivatives are split into exchange-traded and over-the-counter, or OTC. Exchange-traded derivatives are on organized exchanges. Exchanges like the Chicago Mercantile Exchange enhance liquidity. OTC derivatives are privately negotiated. They carry higher counterparty risk. Managing risk is paramount in finance. Hedgers use derivatives to mitigate losses. They seek stability in uncertain markets. Futures contracts lock in selling prices. If prices drop, farmers are protected. Speculators are drawn to the derivatives market for its potential rewards. They embrace uncertainty, aiming for significant profits. However, speculation carries significant risks. Losses can be substantial, especially with leveraged derivatives. In an ideal world, financial markets would be perfectly efficient, with asset prices reflecting all available information. However, markets are not always perfectly aligned, and price discrepancies can arise due to liquidity constraints or trading costs. Arbitrageurs seek to capitalize on these inefficiencies to generate profits with minimal risk. They act as the equilibrating force, exploiting price discrepancies across different exchanges. As arbitrageurs exploit these discrepancies, prices are pushed back into equilibrium. In derivatives trading, trades align with the anticipated movement of an asset. Traders position themselves based on expected price rise or fall. This approach carries higher risk, hinging on predicting market direction. Bullish traders might purchase call options or futures contracts. Bearish traders might sell call options or purchase put options. Success relies on accurate forecasting and timing. Traders use technical and fundamental analysis to form their outlook. Spread strategies in derivatives trading offer a nuanced approach compared to straightforward directional trades. Instead of betting on a single asset's price, spread trades involve positions in two or more related contracts. This aims to exploit the price difference or spread between these contracts. Spread strategies can be categorized into vertical spreads and calendar spreads. Spread strategies offer greater flexibility and risk management. Arbitrageurs capitalize on price discrepancies. Hedging protects against price movements. Farmers lock in crop prices. Futures markets impose binding agreements. Buyers and sellers commit to a predetermined price. Vital for price discovery and risk management, contracts provide certainty and predictability. Standardized contracts are crucial. They enhance liquidity, transparency, and mitigate risk. Futures markets provide a reliable platform for trading and risk management. Futures trading involves a dynamic interaction between buyers and sellers. Margin is a good faith deposit required to enter into a futures contract. A long position agrees to buy the underlying asset at the specified price. A short position agrees to sell the underlying asset at the specified price. Profits and losses fluctuate with the price of the underlying asset. Futures exchanges use marking to market to manage risk. Profits are credited and losses are debited. The dynamic nature of futures trading demands risk management and market understanding. OTC derivatives offer customization and flexibility. Contracts are tailored agreements. They combine interest rate and currency swaps. The OTC market allows bespoke contracts. They extend to a wider range of assets. However, they carry higher counterparty risk. Not guaranteed by a centralized clearinghouse, they provide valuable risk management tools. Understanding OTC derivatives is crucial. Swaps and forward rate agreements, tailored solutions for specific needs. Swaps involve exchanging cash flows linked to various assets. An interest rate swap might involve paying a fixed rate and receiving a floating rate. Swaps and FRAs are tools for managing interest rate risk. Dealers and investment banks. Dealers provide liquidity and customized solutions. They quote prices and manage inventories. They hedge exposures and structure transactions. They offer market intelligence and risk management. The derivatives market has witnessed exponential growth. In 2023, the notional amount of OTC derivatives was $632 trillion. Derivatives facilitate risk management, investment, and speculation. This growth reflects the interconnectedness of the global financial system, highlighting the crucial role derivatives play in modern finance. Untangling the web of obligations. Netting offsets obligations, reducing credit exposure. For example, if Institution A owes Institution B $50 million and Institution B owes Institution A $30 million, netting results in $20 million. Netting enhances market stability. The remarkable growth of the derivatives market reflects broader trends in the global financial system. Increasing volatility and uncertainty in financial markets is a key driver. Globalization has intensified market fluctuations, driving demand for sophisticated risk management tools. Institutional investors, such as pension funds and insurance companies, have propelled the derivatives market. Technological advancements in computing and trading platforms have fueled market growth. Regulatory developments have also contributed to the growth of the derivatives market. The financial crisis of 2007 to 2008 exposed the potential perils of derivatives. Derivatives, especially in unregulated over-the-counter trading, amplified the crisis. At the heart were subprime mortgages, securitization, and credit default swaps. Subprime mortgages were bundled into mortgage-backed securities. These securities were sliced into tranches, marketed as safe investments. Credit default swaps acted as insurance against borrower default. They became instruments of speculation and systemic risk. As the US housing bubble deflated, subprime mortgage defaults soared. Mortgage-backed securities plummeted, triggering investor losses. The interconnected financial system turned a housing correction into a global crisis. Post-financial crisis, regulators reformed the derivatives market to reduce systemic risks. Key initiatives included standardization and central clearing of OTC derivatives. Central clearinghouses mitigate counterparty risk. Reporting OTC transactions increased market transparency. Stricter capital requirements aim to strengthen financial resilience. Derivatives are powerful tools for risk management. Investors use derivatives to mitigate risks and enhance returns. However, their leverage can lead to instability. Informed decisions and robust oversight are crucial. Understanding derivatives is essential for investors and treasurers. This includes pricing models and risk management. Assess risk tolerance before using derivatives. Derivatives can enhance returns but require understanding risks. The derivatives market constantly evolves. Tech advancements and regulations shape derivatives' future. Electronification enhances transparency and efficiency. Fintech challenges traditional institutions. Balancing innovation with stability is essential. As we conclude our exploration of derivatives, it's clear that the landscape is ever-changing. The perfect balance between innovation and stability is crucial for the future of financial markets. As technology advances and regulations evolve, the derivatives market will continue to adapt, providing new opportunities and challenges. Special thanks to Wikipedia for providing a structure of knowledge. Thank you for watching our channel. If you found this video helpful, please like, subscribe, and hit the notification bell for more insightful content. Stay tuned for our next video.